Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
When I met you in the summer.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of the Equity Mates Summer Series. This is a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, welcome. We hope you're having a great summer break and enjoying this series. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. Very excited for this summer series to continue as we speak to 12 great financial advisors and fund managers to understand their investing process, the lessons they've learned throughout their career, how they would start investing today, all to draw out those actionable insights to help us make 2025 our best investing year yet.
Now, joining us in the studio today is a returning guest to Equity Mates, Elise Kennedy from Schroders. She is an investment analyst and has had plenty of experience in markets, formerly Vice President of Equity Research at Morgan Stanley and a director at Jarden. She has an MBA from the University of New South Wales, and not only that, somehow finds time to be a surf lifesaver and recreational pilot. We love chatting to Elise because she always comes with some pretty good tech stock tips.
Now, Bryce, you gave Elise her full bio, but I think the one thing that you brushed over was Schroders.
Yeah.
Something I learned about them recently. Well, I heard, I don't know if it's true. I haven't actually asked them. They managed the Queen's money.
They manage royal money, yeah.
Yeah. So now the King's money, I guess.
Yeah. So they're massive in Australia.
So I mean, they're massive in Australia, but they're bigger in the UK.
They're huge in the UK. In the UK. Yeah.
It would be a real point of pride to manage the King's money in the UK.
It would be, absolutely.
And it would be it would really hurt if you lost that mandate, I reckon.
Yeah, that would.
Yeah. So look, if it's good enough for the King, it's good enough for Equity Mates, as I always say.
That's it. Now, before we jump into it, we want to say a huge thank you to Viola Private Wealth for their ongoing support of this series. Viola Private Wealth specialises in managing and growing assets while helping families pass on their wealth with confidence. Managing over $2.5 billion in assets, their approach goes beyond financial planning. It's about creating a legacy that lasts.
With decades of expertise, they guide families through the complex terrain of intergenerational wealth planning, crafting strategies that stand the test of time.
Trusted by members of the Equity Mates community, Viola Private Wealth helps individuals grow and protect their wealth. To find out more, head to violaprivatewealth.com.au.
All right, well, with that, let's get to our conversation with Elise Kennedy.
Well, Elise, welcome to Equity Mates.
Thank you, as always, for having me back.
Yes, great to have you back. So, investing is a lifelong journey, never stops, pursuit of excellence, and I think Buffett always says that you can never master it, and they're I guess, a great example of literally learning and that their whole life. So what are you working on right now with that in mind?
What I'm really valuing within coming into an organisation that's really value focused is looking at a lot more free cash flow. So, for example, if I take Ramsay Healthcare, recently went to the hospital over in Perth for their Investor Day, and just looking at the influence of the robots. And I went, I've had one of these startups that have come through, and Stryker over in the US, as I'm sure you're familiar with, and just the growth and what influence that's having and plays a role when it comes to bringing down the cost. So at the moment, I'm working on the combination of the two and seeing the fruition and how the two can actually go together and come to play a role for those listed and unlisted. And eventually, hopefully, the unlisted ones also make free cash flow, because I know what that looks like now.
I mean, that's really cool, because like the conversation around AI is like, where's the value going to come? And, you know, the conversation around some of the big large language models is, are they going to be a commodity, and is there going to be any like real benefits there? But like what you're saying is the most exciting parts of the technology world are being applied to perhaps some of the more boring parts of the traditional business world.
Actually really need these types of technology or systems and generation of IT to make them work. Take data centers as another example. With the abundance of data, which every single company is saying, we've got these records, we've got to make use of them, we've got data that we can create a better customer service. But if you don't have a powerhouse to be able to drive that, then you're not going to be able to generate that, and you're going to be behind at that front. So I think that's what I'm really appreciating more and learning. It's not just about going and investing in some of the early companies that are generating it, but also what are the benefits that we're realizing from and getting in these other more sustainable companies which have to exist at the end of the day.
Yeah. Now, Elise, you cover a lot of sectors across the Aussie market. What areas are really appealing to you at the moment? And I think conversely, where are some red flags?
It depends if you're a short-term investor or if you're a longer-term investor. So short-term, obviously, you are getting a lot of attraction towards, your ETFs that are more tech orientated, that are your NASDAQs, data centers. So on a short-term basis, I think we continue to see momentum around that. I am taking more of an interest in the benefits of where that's coming from a valuation standpoint. With Ramsay, if I'm going back to that because it's front of mind at the moment, 50% of the labour costs is their cost base. You've been seeing inflation rates there, 4 to 5%. Some of the nurses, EBAs, are asking for 15% in New South Wales. And when your top line is growing, 4 to 5%, 6% at best at this point in time, but only growing higher with all the age demographics, I feel as though even if you just look at where the index is falling in the valuations, takes a PE of an all-time high, 100 and something times 1 year forward. Sure, it hasn't got the cash coming through, but then you'll have, around 10 times or lower all these fallen health stocks, and pathology falls within there as well. But 70% of all prevention comes from going and getting those blood tests. So that's where I'm kind of thinking that for me is what's appealing, to find a way to be able to find, is it a second derivative or is it the first derivative of some of the tech investments, so aligning those two. What am I concerned about? What rings alarm bells? You've seen the cost of living pressures and the PEs of banks. They've moved from 17 times I think they're trading at PE versus the historical, 13 and below. I think CBS on 24. And why is it trading so high? It's only because their earnings growth is flat. Their repayments and so on and so forth. But I think as we continue to see the cost of living pressures, it feels like it's all over the press. Is it really sustainable to have those types of investments on that side? So that concerns me to some extent. And on the flip side, you've got resources like this. Is China doing something? Is China not doing something? That to me is perhaps a trade.
So you mentioned a number of different sectors there. And one thing that we really want to understand through these interviews is how the expert investors we're speaking to keep up to date day to day with kind of everything, but then also develop that deep domain expertise you need to make an investment decision around like a Ramsay one day and then a CommBank the next and then a Rio the day after. So what's your process and what resources do you rely on to approach an industry and build that understanding around it?
Yeah. One of the best things I love about Schroders is we work on everything. Hence why my knowledge has gone from knowing just technology and media to now having more of a versatility when it comes to being a future portfolio manager. So how we work it together is every single week, at least 3 times in the mornings, we come together and discuss all the stocks, all the sectors, any of the moves. But then in the afternoon, each of us has another hour slot to go through our specific sectors. So for me specifically, I've got healthcare, office REITs, smaller retailers, tech and media, and within that a broad diversity of stocks. And we'll go into a deep dive. We'll speak to management. We'll speak to board members. We'll do investor meetings. We'll liaise with analysts. We'll have our own models to find out, where is there a different valuation. And we come together with, again, I think they're some of the smartest minds, having come from the sell side. I got to see a lot of different ways of thinking and ways of investing. And Schroders was one of my top picks. And I think it's a really good way for us as a team, because the combination of regular market meetings, being across all sectors, comparing different attitudes towards stocks, we live and breathe this. We'll all be on group chats on the weekend and we're sending around stuff, as nerdy as that might sound.
So, Elise, let's go back to the early days. What was the trigger or the point where you realized that you were really interested in investing or finance, and perhaps talk through that journey and to kind of where you've made it to today?
Well, the first thing I think that triggered me was when my parents were there looking at their superannuation and going, where the bloody hell is this going? I'm a school teacher, Dad's a plumber. So, a significant portion of our wages goes into a fund, and that's our future. And therefore, that was the first step. I then was at CBA and I did a rotation studying strategy, did a stint in marketing that didn't last long. The global markets floor, though, had this energy and this buzz and this desire to do something and make something, and you didn't know what was going to happen next. And for me, I do like quite a bit of stability, but this was trying to find and generate returns that I felt that they were passionate about that. And with that there, I started to apply for various different jobs and take more interest in my studies in finance, and realized that that came easier, and I enjoyed it because it had some logical ways of thinking. And Morgan Stanley over 10 years ago, I like to think I'm not even that old. But that is probably the groundings of it. And from there, I feel so grateful that I found a job and an industry that I'm passionate about and live and breathe. So
that early story there spans some pretty sizable and notable financial institutions. Combank, largest in Australia. Morgan Stanley, one of the largest in the world. You're at Jarden. Now you're at Schroders. What are some of the lessons you've learned from those institutions that have really informed how you approach money and investing that money today?
I think you have to believe in what you invest in and be prepared to lose. I also think, for me, we were talking about the statistic before with regards to that performance, whether it is, I think you said, statistics with, I found Morningstar reported that 42% of the US outperformed the benchmark, but I do say that 90% it was, they reckon, if it's a long-term investment style, if you get your benchmark, which obviously would tend to be lower for the longer-term investors, then 90% outperform. So
their benchmark.
And we have, like at Schroders, for example, we are much longer-term investors. We're not more momentum short-term traders, and that's part of our investing in fundamental long-term companies. But you have some other statistics.
Yeah, the S&P Global have their scorecard where only 9% of US investors have outperformed over the past 10 years. And in Australia, it's something like 17 or 18%.
I feel as though when you go into the market, there might be some funds that potentially are becoming complacent, and maybe that drives some of it. But then I look at where I've been and the information and the flow of the way that we look at things. And if you can't see, the passive investment is going to only drive the consolidation, as I say, towards a market, right? So if you haven't got those active sides, then you're not generating alpha. So
that is passive investing, but you don't generate alpha. But I mean,
but that's the whole thing. Do you want to get those 70? Do you want to get into those funds that have at least the 17%? That's more my point.
I think no one disagrees that if you can find the active manager that consistently outperforms the index, that's where you want to be. I think that those that argue for passive investing argue it's hard to find those people, and it's hard for those people to continually outperform. And so it's like if it was here's the 17, here are the 83, just stick with the 17, easy. No one would invest passively.
Not only finding them, but then for retail investors to get access.
Well, that's the other thing.
Some of the best don't need to go direct retail because
They've got
fine.
institutional
They're
money.
fine.
Yeah,
They've got
yeah.
institutional money.
But like
Yeah.
Renaissance does 66% a year. They don't have an active ETF on the ASX.
Well, this is some of the challenges as well, and who picks up the phone and gets to know where to go and put your funds. And I even find some of the statistics that are getting out there more recently with females becoming more prevalent in the workforce and higher, earning more than they previously did as well, and they're not having as much of the financial access given a lot of the retail side as well, and the advisory part is males. There seems to be this gap in the market that they're not getting tapped into as well. So yeah, there's various components. But yeah, I think it's interesting that you point out it's the track record is what we were saying. Like how long is that 17%? How long is the 40%? It depends on the time frame and how long you can sustain it. Do you want to take a 3, 5, 10-year benchmark?
You know, it's not an either or. I think one thing that we've learned over our journey is that so much of finance is put in opposition to each other. Your value or your growth, your stocks or your property, or your stocks or your bonds. And like you're taught that you kind of have to pick a side because there's only one right way to make money. And this is the best example of it, I reckon, passive v active. And it's like plenty of active investors have made a lot of money. Plenty of passive investors have made a lot of money. And as an investor, you don't have to choose. You can have the best of both worlds.
Yeah, and that's called a diversified portfolio.
Yeah, exactly. So personally, do you have an investing philosophy?
I don't think I follow an exact mandate. I find as in my life as a whole, I like to have a diversified portfolio. So I feel as though my job and my work is a lot of exposure to equities. At Schroders, more valuation, not value focused, just to be clear. But we do have a skew that is less at the moment towards tech, but that works perfectly for me, who personally is more tech orientated. So that gives that diversification. But then when you talk about other asset classes, whether it be your more sustainable properties or bonds. For me, my investment philosophy is to diversify myself, that you've pretty much got a market neutral position largely.
Well, Elise, we're just going to take a quick break here to say a massive thank you to our series sponsor, Viola Private Wealth. Transferring wealth is as much about family harmony as it is about finances. With expertise in investment management and tax-efficient planning, Viola Private Wealth ensures assets are preserved, relationships are strengthened, and your legacy endures. To find out more, head to violaprivatewealth.com.au.
What's your financial goal?
My financial goal, I think, is really actually as Miss Universe as this is going to sound, I really want to create something that you can replicate for others to keep on returning back to the world. Okay. So what I mean by that is, your triple bottom line, people, profits, planet. And that's where, if we go back to the original kind of conversation we had of your superannuation, this is creating a sustainable future. More I read up and learn about the healthcare system and the pressures that it's under, and then, the government funding, which is our taxes, and the needs of, the cancer medication that can help individuals, but is only there available for some of the different echelons of society. To me, I would like a more equitable outcome. And so whether or not we can do that through capitalism and the businesses that we invest in, that to me is part of why I like the thought that we invest in long-term businesses that might aren't going to be short-term punting on the market and being short-term traders. At Schroders, we choose businesses that we believe are going to generate free cash flow and are investing for the better of outcomes of the business and what is right for the business and what their strategy and goals are.
Nice. One question we've been asking everyone as they come in is how you would set up a portfolio for retail investors we've said the next 30 years, but just for a long-term portfolio. And I think, if you want to give specific assets or specific funds or companies, great. But I think what we really want to understand here is how you would approach that portfolio construction question, building something for a retail investor, thinking long term. So yeah, how would you go about setting up a portfolio today for the next 30 years?
So you really do, it depends on what your lifestyle is. If you do want to, if you're happy to live in a van versus do you want to sustain a more extravagant lifestyle than that? Those are considerations, but also, do you have dependents? Do you have children? Do you have others within your life? Because obviously, extremities happen? Do you have a side buffer there? You have to really take a holistic approach rather than just saying what assets you put into, because you might need liquidity and some of those might not give you liquidity. Equities markets, say, for example, tend to be investments and skewed more towards a younger generation that can weather the ups and downs of volatility, although it seems to just go up lately. Whereas if you are going towards a later stage of life and or have something coming up, then you have to be able to get that access sooner, and that might be a shorter term deposits and those bonds that make us so excited in life.
Well, Elise, we want to turn, I guess, to some lessons for the audience, and I guess we kind of split them into short and long term. So let's start short term and then get to long term. So short term, it's been an interesting 12 months. As you said, it seems like everything's going up. I think at time of recording, the S&P 500 is up like 40% in the past 12 months. The ASX 200, boring index, it certainly isn't. It's up like close to 20% in the past 12 months. Times have been good, and it's really come off a back of 18 months which were really tough with rising interest rates and inflation. So what's this period taught you about markets and about investing and maybe about yourself as an investor?
Yeah. History always isn't logical and a precedent for the future. Having tutored economics, it seems to be defying some of the logic. I'm sitting next to Martin Conley, who's one of the longest serving fund managers at Schroders. For 30 years, he's been investing in there. And it could be still on the wave. And that's something he wrote in one of his Outlook newsletters. And you'll be riding this wave and it's great, but then all of a sudden it can break. Given if there's any other surfers out there, they'll get this. If you're still learning to surf or you don't know what to expect on this wave, it's all fun and you're enjoying the time. But then when it breaks, you're either going to get dumped and rolling, not weighing which way's up from down, or you're going to ride it smoothly. It depends on where you're positioned. So I think that's something that I'm learning is it feels, and it has since I started back in the industry over 10 years ago, everyone's been very doom and gloom. But remember, I'm an optimist through and through. But it does feel as though there has to come to a point where these pressures aren't sustainable. Look at all the costs of living. Look at the way these markets are valued. There's a flow of funds being printed and continuing. I don't know how it stops and if it's a bubble, but that's something I probably am more acutely aware of than I previously appreciated.
Practically speaking then, for those listening and, hearing, dollar cost averaging and all that sort of stuff, like does that mean at times like this, invest less, sit on the sides and wait? Like how do you think for a retail investor you practically invest with that? I guess, is the wave going to break?
For me, that's why I like to hedge that portfolio, because if one thing doesn't do so well, then I'm exposed to something else that will. And I've still got the hard assets there that will be there. I think you just look at gold and I mean, that's there, and there was a line outside the bullion place down in Martin Place, and I think that's there for a reason. But how do you play that practically? Beyond that too is be prepared, keep watching, know the different asset classes if you do have those scares, but also be prepared that if you believe in, say, a tech business that's highly valued, like I look back still when we had the last tech sell down, there were some really good companies that just pulled back in valuation just for the sake of it. Like even REA, it was like $3 something back in the 2000s, and Square, I think, was like similar amount, just because it all got sold off. So you have to go back, and I've always said this, what are good businesses? Who are the leaders? Do I believe in what they're doing and the sustainability, or am I buying this just because the share price and everybody else around here says it's great? Like data centers, they're great, but I don't know how you're going to keep on building the energy needed for them. Thinking about the whole picture and staying on top of the conversations that are existing. To me, again, that's why I love doing that startup and speaking with them is that helps you to kind of hear what is coming through the pipeline to be prepared. And then if you think, hey, this actually, I'm invested in, let's just say I believe in Origin Energy. Oh, hold on, nuclear's just been approved by the Australian government, hypothetically, just to be clear. And this company, let's call it XYZ, has got this technology that's already been speaking with them. Like, should I really be getting out of this at this point in time? So that's an individual thing. It's just keeping on top of the rhetoric, but also having and ensuring that you've got those sustainable funds and practical assets in case there is some crash scenario.
So if you could go back to when you first started out in your career, if there was one lesson that you could teach your younger self, what would that be?
I wish I had an awareness of markets earlier. You know, you can get a paper portfolio yourself through the ASX to have a play, because I find when people start generating money themselves, that's when they start to go to put it to use. But I'm like, maybe you should have a try before. And that's something that I wish I did more of. I just didn't have the awareness, and it was only later on that somebody said, you can try this paper portfolio, because that helps to teach those lessons before you lose $1 from them. And yeah, testing and learning, listening to others as well, but not taking everyone verbatim. Everyone's got a view. And everyone, as I say, having sat on the sell side, has a very different view. And sometimes more value skewed funds work, sometimes others don't. But that's why, as an investor, you have the opportunity to move money. And we were talking about it again back where, you know, a fund and a benchmark, you outperform the benchmark each time, and it's only for depending on what period. It's like, well, I have to be attuned to the market to know, is there a whole skew towards more safer style assets, or should I be going and driving up the momentum at the moment? So I think there's still a bit of momentum trade out there in the market. We haven't had this little crux, but whether or not, if, when, how that wave breaks.
Yes.
Yeah.
I can surf, so it's fine.
Well, Elise, it's always a pleasure having you in the studio and having you back in speaking to the Equity Mates community. If you haven't heard any of our previous episodes with Elise, make sure you go back into the feed, because there are plenty. But thank you, as always. If anyone wants to listen to your podcast, Talking Tech, where can they go?
You can go to the page, Talking Tech with Elise Kennedy, and you'll see a bit of background. Also have a few of your links as well on there.
Nice. Love that.
And all the episodes that we recorded over the historical years. And then in the new year, you should see quite a bit of background and new content coming your way.
Awesome. Well, looking forward to that.
Yeah.
Good luck with the relaunch. And great to have you in. Thank you so much.
Thanks for having me, as always.
Thanks, Elise.
Before we go, we'd like to thank Viola Private Wealth for their ongoing support of this series. Creating a lasting legacy requires thoughtful planning and expertise. Viola Private Wealth brings a blend of tailored strategies and decades of experience managing assets to help ensure your wealth benefits generations to come. To find out more, head to violaprivatewealth.com.au.
Now, make sure you're subscribed to Equity Mates wherever you're listening or watching to this podcast, because we have some great guests coming up. Next up, we've got Katrina Burns, who joined us all the way from New York. And then after that, we've got Chris Weldon, one of the early experts who joined us on Equity Mates, someone who we've loved speaking to and learnt a lot from. So some big interviews coming up. Make sure you're subscribed so you don't miss them. But Bryce, that'll do us for this episode.
Love it.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.